This Chartered Institute of Management Accountants London defined standard cost as a predetermined calculation of how much cost should be under specified working conditions. It is built up from an assessment of the value of cost elements and correlates technical specifications and the quantification of materials, labor, and other costs to the prices and or wage rates expected to apply during the period in which the standard cost is intended to be used. Its main purpose are to provide a basis for control through a variance accounting. This is actually the standard cost. The main points which we have to remember is first is predetermined calculations. This is being done under a specific working conditions. The next, they have set certain standards, maybe of a machine time, maybe of a labor time, maybe for a material, maybe for a overheads. So these are the things which is been set already. The next, it also provides control through variance accounting. And it also taken as a basis for valuation of stock and work in progress. Why this too has taken? Because it has to fix up the selling prices. All this comes under the main points under the standard cost. Now coming to the standard costing. Standard costing is the preparation of standard cost and applying them to measure the variations from actual cost, analyzing the causes for variations, and view to maintain a maximum efficiency in production. It is a technique which uses the standards for cost and revenues for the purpose of control through variance analysis. Now, ascertainment of standard cost under each element. We have three elements under the cost accounting. One is material, one is labor, and the another one is overhead. So taking the material, we have a standard material or a standard quantity. The labor, standard time. The next is overheads, the standard overhead cost, etc. We are supposed to ascertainment. The second, the measurement of actual cost we have to take into the account. Then we have to compare the actual cost with that of standard cost. Now, if any analysis of variance is to be taken up, whether it is favorable or unfavorable, favorable is when your actual cost is less than your standard cost. That means excess of standard cost over actual cost, then it is favorable. But your actual cost is more than your standard cost, then it is unfavorable. So what is the cause? What is the effect that need to be analyzed and need to take a remedial action? That's the reason why a standard cost need to be taken care of. Now, we have the differences between a standard costing and the budgetary control. Now, standard cost, usually they say it is a target. We have to reach the target and we have to perform beyond the target. Budget is a limitation. It is a ceiling which cannot go beyond that. We have to perform within that. So budgetary control is the limit. Standard cost is a target. Now, the standards are estimated based on technical assessments, whereas the budgets are based on the past figures which need to be adjusted and projected for future. So that is called as budgets. Now, budgetary control deals with the operations of the department of the business as a whole, while as Standard costing is totally concentrated on manufacturing of a product because the material, labor, and overhead relating to the manufacturing of a product will be taken care. So that's the reason why standard costing is basically for manufacturing of products. Budgets can be done for overall. The next, the standards are set mainly for production and the production expenses. Budgets will be taken for, that is, you will compile all the items, incomes, and expenditures. Now, coming to the budgets or the projection of your final accounts or a financial account, but standard costs are the projection of your cost accounts. These are the differences between your standard costing and budgetary costing. Now, what are the prelims to be establishment of standard cost that we have to take into the account? First of all, we have to establish the cost centers. Now, in an organization is divided into different centers: a profit center, investment center, a cost center. Mostly, the production department can be treated as a cost center where usually the manufacturing of products are being taken into the account. So we are supposed to establish the cost centers. Now, the next is the type of standards which we have to establish. One is current standard. What do you mean by a current standard? A standard which set taking the related current conditions into the account for over a short period of time, it is called as current standard. We also have an ideal standard. The ideal standard is based upon a very high degree of efficiency, which is rather impossible under the normal circumstances, which is ideal, you know. See, if so and so conditions are prevailing, only you can reach that standards. If not, you cannot able to. So the conditions are normal, then normal standards can be achieved. But ideal standard supposed to achieve only when you know those things are desirable conditions of the performance are expected, then only you can reach this ideal standard. Then expected or attainable standard. We have a standard which is anticipated during a future specified budget period, and taking that as a base, we can expect or we can attain such standards. Now, basic standard. The standard which is fixed for long periods to help in forward planning. Such kind of standards, we call it as the basic standard. Coming to the normal standard, the average standard which it is anticipated can be attained over a future period of time, preferably long enough to cover one trade cycle. Then such kind of standards, we call it as a normal standards. Now, developing or setting of a standards. When we want to set the standards, we have to take three elements. One is materials, the another one is labor, and the third one is the overhead. Now, direct material cost. Now, when we want to know what is the direct material cost, so we have to set the standard relating to the materials. We also need to set the standards for price. Standard price, standard quantity of materials, that both we have to set. Now, coming to the direct labor, under the direct labor, we are supposed to set the standard time as well as standard rate, that is the wage. The wage as well, standard wage and standard time to fulfill that particular task. Those two we have to set. And in the overheads, we have variable overheads and fixed overheads. We need to set the standards relating to variable overheads as well as the fixed overheads. These are the things which we have to take. That means standard overhead rate, which is variable, standard overhead rate, which is fixed. Standard, one more thing, hours we have to take into the account. That is also need to be taken care. Standard time, the time which the worker is spending, or the cost which is incurred, that also we need to consider under the overheads. Now, apart from this, let us see what are the variances which can be studied under the analysis of variances. Now, we have a direct material variances, direct labor variances, and overhead variances. Now, let us take into the account the material variances. Now, the material variances. So, I can say the material cost variance is divided into two. One is material price variance and material usage variance. Material usage variance. Now, again, material usage variance is divided into two. Material mix variance and material yield variance. This is what we have to take into the account under the materials variance. Now, materials cost variance, the formula we have is standard cost for actual output or actual quantity, we can say, minus actual cost of actual quantity or the material used. So rather we can write it like this. We will write the standard cost into actual quantity minus actual cost into actual quantity. So this is how the material cost variance will be worked out. Now, the material price variance, the formula for material price variance, the material price variance formula actual quantity into your standard price minus actual price. Your material usage variance or a material quantity variance is equal to, we have here two. One is material mix variance, under the material mix variance, we have again yield variance, usage variance. These two also need to be taken. First, to calculate the normal one, it is the standard price into your standard quantity minus actual quantity. This is a simple one where material usage variance can be calculated the standard price into standard quantity minus actual quantity. So this is how we are supposed to work out. Now, the next, we need to take the material mix variance and the material yield variance. So first of all, we'll work out a problem relating to this simple one. Then we'll move on to the material yield variance and the mix variance. Okay. So let us work out a simple problem where material variances can be calculated. Now, shall I, have you taken these formulas?
Yes, ma'am.
Now, let us take into the account, calculate all material variances, and he gave you the raw materials, which is A and B. Okay. The standard cost he gave us. The standard cost he gave us. These are the units. These are the rate. And this is the total. So I'm taking for A is 40 units at 50 rupees. So it is 2000, right? The next 60 units, 40 rupees, it is 2400. So you can say here total is 100 units and the value is 4400. This is your standard cost. Okay. Now coming to the actual cost. Under the actual cost, same for A and B. Now units, rate and total. Under the actual, he gave you 50 units. The rate is also 50. It is 2500. And 60, it is 45. 60 into 45 is 2700. It is equal to 1110 is the total, and 2500 and 2700, which is equal to 5200 is your actual cost. Right? So now let us work out material cost variance. Have you copied this? Have you copied?
Yes, ma'am.
Yes. So now let us work out the material cost variance is equal to standard cost minus actual cost. Standard cost is 4400. Actual cost is 5200. So which is 800. Now we can, which is a minus figure. 800 is a minus figure. We will write as unfavorable or adverse. So you can write A. Instead of writing as a negative, no need writing as negative. Rather you say A. A stands for negative, adversities, which is unfavorable. The next, material price variance is equal to actual quantity into your standard price minus actual price. For A, actual quantity was how much? Actual quantity was 50, right? So for A, it is 50 actual quantity. The standard price is 50 and actual price is 50. That means 0. 0 into 50, this is nil. Now coming to B, the actual quantity was 60. Your standard price is 40 and your actual cost is 45. So that means 60 into 5, which is 300, which is adverse. Which is adverse. Okay. Material price variance under B, it is adverse. The next, material usage variance, we have to calculate. Followed this? Have you followed?
Yes,
is this clear? Shall I rub it off?
You can.
So now material usage variance, which is equal to the formula, the standard price into your standard quantity minus actual quantity. So now the standard price for A is equal to 50 and standard quantity was 40 and actual quantity was 50. So that means it is the 10. 50 into 10, which is equal to 500, which is adverse. Now B is equal to your actual quantity. The standard price is 40. Your actual standard quantity is 60. And your actual quantity is also 60. So which is equal to nil. So now Here, material cost variance is equal to material price variance plus material usage variance. We have to verify like this. Now, material price variance is 300 adverse plus material usage variance is 500 adverse, which gives you 800 adverse. Even when we calculated the material cost variance also, we got 800 adverse. So, both are equal. That means what we have done is right. Followed?
Yes, ma'am.
Yeah. Next, we have material mix variance and material yield variance. The formulas for material mix variance, we have two into the account. So if you have completed this, we'll go to the next. Shall I start the material mix variance?
Yes, ma'am.
Yeah. Now, the material usage variance, we have two. One is mix variance. The another one is the yield variance. So now coming to the mix variance, we have under this two options. The first option is your actual weight, actual mix, rather we can say actual mix doesn't differ to your standard mix. It doesn't differ. The second option where your actual mix will differ. That means it's here. Sorry, this should be equal. No, this should be equal. This is same. This is not same. So these are the two options which we have to take into the account. Here, both are equal, whereas here both are not equal. They differ. So we have a different formulas for this. So let us work out different formulas. Now one, where your actual mix is equal to your standard mix. Then the formula here is your standard cost, the standard quantity minus actual quantity. This is one formula which you have to take. Okay. The another formula is there could be some shortage. Due to shortage, we are using the another formula. That means we have to revise our standard quantity. So standard cost of revised standard quantity minus actual quantity. Because of shortage, we have to revise the standard quantity and multiply with your standard rate. You'll get standard cost of revised standard mix minus actual quantity. So this is one formula we have to use when your actual mix does not differ with standard mix. Now, your actual mix is differing with standard mix. Then in such case, we have a formula that is the total weight of your actual mix, total weights of actual mix divided by the total weight of revised standard mix into your standard cost of revised standard mix into minus, sorry, you have to take minus standard cost of actual mix. This is the formula which we have to use when your actual mix is not equal to your standard mix. This formula we are supposed to use. The next is the material yield variance. Shall I rub this one?
Yes, ma'am.
Okay, ma'am.
No, madam, once
Yes?
you explain the second bit, madam.
This one.
Actual mix is no.
Actual mix does not differ standard mix. Nana, actual mix, like let us say, it is like in the earlier problem, your actual mix, that is your A is equal to 50 units. Earlier problem when we are working out, A is equal to 50 and B is equal to 60, the total is equal to 110. But your standard mix, A is equal to 50 and B is equal to, A is equal to 40, B is equal to 60, it is coming to 100. So your standard mix is 100, your actual mix is 110. That means your standard mix is not equal to your actual mix. Standard mix is differing with your actual mix. Understood?
Yes, ma'am.
There you have to use this formula.
Okay.
Right. So in the next, material yield variance. Let us work out the material yield variance. Now, the material yield variance, to calculate the yield variance, the formula is standard rate into your actual yield minus standard yield. So your yield variance will be standard rate into actual yield minus standard yield. Now how to calculate the standard rate? Standard rate is equal to your standard cost of standard mix divided by your net standard output, which is nothing but the gross output minus the standard loss. That gives you the net standard output. So this is a formula for yield variance. Here also you are taking this formula when your standard mix is equal to actual mix. Now you have one more situation where your standard mix differs with actual mix. When it differs, then your standard rate, the formula, this formula is same, only the standard rate formula will differ. That is equal to standard cost of revised standard mix, standard cost of your revised standard mix divided by the net standard output. Net standard output. These are the two formulas we have to use under the yield variance and the mix variance. Okay, so let us work out here. Shall I rub this? I'm rubbing this. Now, the revised standard mix for the previously we have taken A and B, where we will take units, we will take rate, we will take the total. Now, see your standard units for A and B put together is 100. Actual units of the actual mix is equal to 110, right? So what we will do, for 50 is equal to 110, then 40 is equal to how much? So 40 into 110 divided by 50. So 5 and 5, 0 and 0 get cancelled.
Divided by, ma'am?
1 minute, 1 minute. 1 minute. Ma, the standard mix. See, standard mix for 100, A is equal to 40. For 110, what is your standard mix? 110 into 40 divided by 100, which is equal to 44. So this revised is 44. This is Nana This is the total in standard quantity. This is the A standard quantity. The earlier which we have taken, A is equal to 40. And this is the actual mix. Actual mix is equal to 110. So what we did, 110 into 40 divided by 100, we got 44. The next we will calculate for B. We will calculate for B. B is equal to, for 100 it is 60. For 110 is equal to how much? 110 into 60 divided by 100, which is equal to 66. That means the revised standard mix, we have made it 110. Now the standard rate is the same. 50. And this is 40. 44 into 50 is how much? 2,200. 66 into 40, 0, 4, 6 are 24, 2, 24, 25, 26, 2,640. So 0, 4, 8, 4,840. 4,840. This is revised standard mix. The next we have to calculate standard cost of actual mix. Standard cost of actual mix. So here, units, rate and total. Here is A. Now, your standard cost remains same, 50 and 40. Your actual is 50 units and 60 units. 50 into 50 is 2,500. 60 into 40 is 2,400. It is 2,900. This is your standard cost of 4,900. Standard cost of actual mix. Now, I'm rubbing here. Let us calculate the material mix variance is equal to your standard cost of revised standard mix minus standard cost of actual mix. That is 4,840 minus 4,900, which is 60 adverse. The material mix variance 60, which is unfavorable. Now coming to the material yield variance. Now, I'm rubbing off this material yield variance. Material yield variance is equal to, we have to calculate the standard rate into actual yield minus standard yield. Now, here 4,400 is, originally we have calculated 4,400 divided by 100 into your actual yield is 110 and your standard yield is 100. So, which is equal to 44 into 10, which is 440 adverse. Sorry, it is the same, favorable. 440 is favorable because actual yield minus standard yield. Actual yield is 110, your standard yield is 100. Now, the material, shall I rub it off this? So your material usage variance is equal to material mix variance plus material yield variance. Your 60 adverse plus 440 adverse, which is equal to 500 adverse. Material usage variance also we got it as 500 adverse. That means it is verified. This is how the material variances need to be worked out. Now let us move on to the labor variances. Shall I rub it off this? Followed? Any doubts? So let us move on to the labor variances. Now, labor cost variance, labor rate variance, or the labor pay variance, total labor efficiency variance, labor efficiency variance, labor idle time variance, and we have labor mix variance, or gang composition variance, labor yield variance, or labor efficiency subvariance. These are the variants which we have to calculate under the labor variances. Now let us see the formulas for each one of it. First, labor cost variance. Labor cost variance is equal to your standard cost of labor minus actual cost of labor. The labor rate variance or the labor pay variance, the actual time, the standard rate minus actual rate. The total labor efficiency variance, the formula for this is standard rate into your standard time for actual output minus your actual time. The next, labor efficiency variance is equal to, you have to take the actual time minus the abnormal idle time is to be deducted. From actual time, you have to deduct abnormal idle time, so that we can able to calculate the standard rate into standard time minus your actual time worked. That we can use it to the account. Next, labor idle time variance is equal to your abnormal idle time into the standard rate. Abnormal idle time into standard rate. This is for labor idle time variance. The next we have the labor mix variance. labor mix variance. The labor mix variance is equal to, here we have to take, as you know, three formulas, three situations we have to take. If there is no change in the standard composition and actual composition, in such a case, the labor mix variance is equal to your standard cost of standard composition minus your standard cost of actual mix. This is first situation. The second situation, the standard cost of revised standard composition minus standard cost of actual composition. Now, the third situation where your actual time of labor differs with that of standard time of labor, then you have to take the total time of actual labor composition divided by total time of standard labor composition, and it is multiplied with the standard cost of standard labor composition minus standard cost of actual labor composition. This is the formula which we have to take into the account. The next we have, whenever a revised standards are being taken into the account, that means the fourth formula we have to apply. The fourth formula is, under the labor mix variance, is the total time for actual labor composition divided by your total time of revised standard labor composition into the standard cost of revised standard composition minus standard cost of actual composition. This are the four formulas we have under the labor mix variance. Now, labor yield variance, which is equal to your standard cost per unit minus actual yield minus your standard yield. This is a formula supposed to be applied for the labor yield variance. Now let us work out the problems under the labor variance. So now calculate the labor variance. They gave you the standard, they gave you the actual, and he gave you the data as the number of employees employed. Under standard, they're supposed to 100, but actual only 90 were applied. Now the output in units, standard expected is 5,000 and actual was 4,800. Now, number of working days in a month is 20 were expected, but 18 only were worked. Now, average wages is per month is 200 as standard, 198 as actual. Now is asking us to calculate the labor cost variance, labor rate variance, and the labor efficiency variance. Now, per month, per man, this is 200. Now, let us work out what is your standard rate. Now, to calculate the standard rate, we have to take the standard cost divided by the number of working days in a month. So that means your 200 divided by 20, which is equal to 10 rupees, is your standard rate per day. Okay. Now, the actual rate per day, your actual rate is equal to, that is actual cost is 198 divided by 18 working days, which is equal to, your this actual rate is equal to 11 rupees. Standard rate, actual rate we have worked out. Now let us work out the output also. Now, to calculate the standard output, they gave you 5,000 units. Okay, 5,000 units. And they say there are 100 employees work for 20 days. That means it is 2,000 man days. 2,000 man days. That means your 5,000 divided by 2,000, which gives you, 2,000 man days. So there are 4,800, no? So let us work out in this manner. Let us say 2,000 man days for 5,000 units. But they produced only 4,800. So 2,000 into 4,800 divided by 5,000. So now 0, 0 get cancelled. This 0 is get cancelled. 5, this is 40. 40 into 48. So this is 0. 4 8s are 32, 3, 4 4s are 16 plus 3. It is 920. 1920 is your man days. Now here for standard it is 2,000, but it is only, for actual it is 1920 man days. Okay. Now we will work out what are the actual man days. These are the standard man days for actual output you can take into the account. The next we will take the actual man days to be worked out. For that, we have to take the number of employees multiplied with the working days. The number of employees were 90 into 18. The man days, actual man days will be 90 into 18. It is 0, 9 8s are 72, 7.
1620, ma'am.
1620 is your actual man days. Actual man days is 1620. Your standard man days for actual output is 1920. Okay. So now let us work out the labor cost variance and the labor variance. Now labor cost variance is equal to your standard cost minus your actual cost. Now coming to your standard cost, see, you have 100 workers, and average wage per man per month is 200. So how much you are getting? Which is equal to 20,000, right? Now, and the output was only this 20,000. This 20,000 is for 5,000 units. But actual output was 4,800. So your 20,000 into 4,800 divided by 5,000. So which is how much? That is 19,200 rupees is your standard cost. Your standard cost is 19,200. And your actual cost is equal to, he says 90 workers and the wage is 198. How much? 90 workers into 198.
17,820, ma'am.
So now Now it is 17,820. So 19,200 minus 17,820. Your standard cost is more than your actual cost. So whatever you're getting, which is favorable. So 19,200 minus 17,820.
1380.
1380 is your labor cost variance, which is favorable. The next, we have to work out labor rate variance. The labor rate variance is equal to your actual time into your standard rate minus actual rate. Your actual time is 1620, which we have calculated, man days, 1620. And your standard rate is 10 and your actual rate is 11. That is 1620, which is adverse. The next, labor efficiency variance is equal to your standard rate into standard time minus actual time. Your standard rate is equal to 10. Your standard time is 1920 and your actual time is 1620. So that means it is 300 plus into 10, which is 3,000 favorable. So now when you want to know labor cost variance is equal to labor rate variance and labor efficiency variance, one is unfavorable, one is favorable. 3,000 minus 1620, if you do, you are getting the same as what you got in labor cost variance. Your labor rate variance plus labor efficiency variance. This is 1620 adverse plus 3,000 favorable. 3,000, that means 0, 8, 9 minus 6 is 3, 1. 1380, the same thing we got, which is favorable. So this is how a labor cost variance to be worked out. Now in the same manner, overhead variances also you have the formulas. Based on the formulas, you're supposed to work out variable overhead variance and fixed overhead variance. Now you will have volume variance, calendar variance, and capacity variance, efficiency variance. All that you are supposed to work out in your variable overhead variance and fixed overhead variance. And let me tell you about the question paper. How do you get is all 5 blocks you have, right? From each block, I think you may get 2 questions in your essay. Because the first is the only theory. First block is completely of theory. The second block, you have your financial statement analysis. So their comparative, you can expect a comparative or a common size or a trend analysis as a important problem. And you can also expect one question from ratio analysis, fund flow, cash flow. So all these you may expect. Now coming to the next is, I think, marginal decision. Marginal decision, one chapter was completely theory, another chapter like decisions where you can expect a problem. So make or buy decision is a very important where you can expect a question relating to a problem, make or buy decision. The next is about the budgets, right? Is that all we have covered? Under the budgets you may get one theory, one problem. Standard costing also you can expect a theory as well as a problem. So mostly you may get the material variance, labor variance, overhead variance. They may give you such kind of questions. So a theory can be expected, a problem also can be expected. So budgets, standards from all chapters are very important, right? But it depends which you are feel it easy. So please thoroughly you study so that you can attempt that in the exam. It all depends upon the examiner. If he can concentrate on all units, then he may give you in all units will be considered for preparing a questions. Any doubts? Anything to be discussed?
Ma'am, do you have any important questions?
Important questions. Nana, I can give you important questions. Like first chapter, you can expect, they may ask you the differences between management accounting, financial accounting, cost accounting. So they may ask you the differences. They may ask you the objectives or the scope of management accounting or the installation of management accounting. The first chapter is completely of theory. So the theory questions you can expect: objectives of management accounting, features of management accounting, scope of management accounting. All this you can expect. Even the management process also can be expected. Right? Is it okay?
Okay.
The next, under the financial statements, you can expect one a comparative and a common size, or they may ask you, write about the financial statements, the importance of financial statements or the limitations of financial statements, how a financial statement can be analyzed and interpreted. So those things can be asked. And from financial statements, you can expect, because they have 5 methods, Nana: comparative balance sheet, comparative income statement, common size balance sheet, common size income statement, and trend analysis. So you can expect, taking these 3 methods, any problem can be expected, and these problems are very easy. When you go through, it is easy to work out, easy to get the marks. So this chapter, please don't leave out of choice. This is very easy. So if you know how to work out, if you follow, if you study, then automatically full marks you can able to get without a, like let us say, any formula need not be remembered. It is just the format, taking the format as a base workout. So sure you will be able to get full marks. If a question appears taking the financial statement analysis as a base. The next is ratio analysis. If you are good at remembering the formulas, ratio analysis is the easiest chapter where you can score the marks, because apply the formula accordingly, you have to work it out. Ratio analysis is also easy. Yes, if you are good at accounts, fund flow statement and cash flow statement is easy, because you know how to open an account, you need to know how to carry out the balances, how to write the, how to see the balancing figure, the hidden information. To arriving at the hidden information, transferring to the profit and loss account, knowing what is the funds from the operations, taking in the fund flow statement as funds from operations. If you are good at accounts, easily you can work out fund flow statement and cash flow statement. Only the thing is, you need to know the format. That format, if you are perfect, accounts you know, then easily you can work it out. So fund flow and cash flow is very easy. The next is about the managerial decisions, marginal costing. Marginal costing is a dead easy chapter, where you know how to calculate a BEP, PV ratio, margin of safety, etc. That formulas, if you remember, simple formulas, if you remember, easily you can get full marks. Even if a theory is given or a problem is given, easily you can able to work out and you can get the marks. The next comes to the budgets and standard costing. Budgets are very easy, girls. Standard costing, it all depends upon how you are practicing it. So I cannot say standard costing is easy. You may say, madam, every chapter you said as easy, but I'm not saying that standard costing is easy unless until you practice it. If you practice it, then standard costing is also easy, but budgets is very damn easy. So comparatively, if you take all syllabus into the account, then automatically all chapters are easy, provided if you have a practice. Practice is a must. Without practice, you cannot be able to you cannot able to score.
All right, ma'am. Great appreciated.
Yes, ma'am?
Thank you so much, ma'am.
Yeah, let me take the attendance and then I'll leave you, okay? Yeah. Right, Nana, thank you and all the best for your exams. Prepare well and write the exams properly so that you can score full marks. And I expect my students in management accounting should score 10%. Right? Thank you. Shall I leave?
Thank you, ma'am.
Okay. Thank you, ma'am.
Yeah, I'm leaving. So we will be meeting in the indirect taxes, right?
Okay, ma'am.
Right, ma'am. Thank you.
Thank you, ma'am.
Thank you, ma'am.